Hey everyone, so glad you could join me. So, in today's explainer, we are diving into this absolutely massive structural shift that's happening right now in the global financial ecosystem. We're talking about money itself changing. It's going from a passive digital asset, stuff that just sits around in an account, into this active, autonomous participant in the economy. It's like finance is literally waking up. And the way you and I interact with our capital, well, it's about to fundamentally change forever. Let's get into it. To really ground this kind of abstract idea, I want you to picture something super relatable. Imagine you're eyeing a specific pair of sneakers. Right now, what do? You check the price every day, you wait for a sale, and you manually click buy, crossing your fingers that your browser doesn't crash, right? Well, according to recent strategy reports from major institutions like the Dutch Central Bank, that is completely the old way of doing things. Soon, an AI agent is going to track down those exact sneakers for you and automatically pull the trigger the very second the price drops below your target. It negotiates, it authenticates, and it pays, all without you lifting a single finger. Your wallet is literally making decisions for you. How wild is that? Okay, let's dive right into our roadmap for this explainer. We're going to cover the awakening of finance, the rise of agentic AI, programmable value and tokenization, how big banks bet on AI, and finally, regulation, risks, and you. All right, starting off with Section 1, the awakening of finance, a structural shift. So we really need to define the two hemispheres of this new financial brain, something researchers are calling the regulatory technological frontier. First up is agentic AI. And listen, we are moving far, far beyond those basic, kind of clunky customer service chatbots or automated scripts that just flag a transaction. Agentic AI introduces sovereign machines. These are systems that possess real agency. They interpret data, make autonomous decisions, and actually trigger actions without any human help. They optimize for yield, they negotiate terms across different protocols, and they manage these incredibly complex back-office functions entirely on their own. Let's cut through some of the jargon here and directly contrast the old paradigm with the new one. On one side, we have passive digital intermediation. That's what we're all used to today. You log into your banking app, you look at your accounts, and you physically tell your money where to go. On the other side, we have agentic autonomy. This is where your money actively moves itself to find the absolute best interest rates, pays your bills at the perfect optimal time, and just automatically optimizes your entire financial life. This shift is a total game changer. It gives the average consumer the kind of financial optimization power that used to be locked away exclusively for high-end hedge funds. Moving right along to Section 2, the rise of agentic AI autonomous systems. Now, obviously, this isn't just about buying cool sneakers. It is absolutely crucial for securing the entire financial system. We're making a massive leap here, going from traditional, super slow manual batch reviews to full-blown autonomous risk assessment. These new AI systems provide real-time fraud detection. They are constantly monitoring and intercepting highly sophisticated digital threats the exact second they happen. And what's really interesting here is the data highlighting a massive shift. Take a look at how the bars for credit transfers completely dwarf traditional card payments when you look at the millions of euros lost to scams. Basically, criminals are shifting their strategies. They're moving away from small-time card fraud and instead focusing on tricking users into authorizing high-value online credit transfers. The stakes are getting incredibly high, which makes these real-time autonomous AI defense systems absolutely indispensable for banks today. Okay, Section 3, big banks bet on AI, institutional capital. I just want you to look at this staggering number, 35%. According to recent global fintech transition reports, this is the average portion of total IT budgets that the global top 10 banks are allocating specifically to AI integration in 2025. That means we are talking about more than $35 billion being poured into making these autonomous systems a reality. And let's be clear, this isn't just about flashy, nice-to-have innovation. No way. This is a hardcore defensive strategy. These institutions are doing this simply to survive the new era of autonomous finance. Let's break that down with some hard numbers from the world's biggest players. JP Morgan Chase, for example, is directing a massive chunk of its $13 billion tech budget into what they're calling their LLM suite. This includes tools like IndexGPT for wealth management. Meanwhile, Bank of America, they've allocated a staggering $4 billion specifically to AI. That's powering things like their virtual assistant Erica, which has already handled over 3 billion interactions. Think about that scale. These institutions are literally re-architecting their entire businesses around artificial intelligence. And you know what? These multi-billion-dollar tech investments are already translating directly into your everyday life. Right now, predictive analytics drive about 60% of all loan decisions in digital lending platforms. When you apply for credit today, an autonomous agent is actually more likely to be making that split-second decision than a human underwriter. This is autonomous risk assessment in action, and it's directly affecting real people's access to capital, right now. Which brings us to Section 4, Programmable Value and Tokenization. The tokenization era. So for these AI agents to truly operate seamlessly, the money itself has to change format. And this brilliantly illustrates the whole setup. We've got this complex tree where trust is anchored by the central bank right at the roots. But if you look at the branches, yes, we have our private bank deposits, but we also now have e-money, European stablecoins, and decentralized DLT platforms. Central banks are actually building these bridges, literally called pontes, to allow wholesale central bank digital currencies to settle transactions of private tokenized assets across this incredibly intricate digital ecosystem. It's like a giant puzzle coming together. Now, smart contracts are the engine powering this whole infrastructure. Basically, they are self-validating digital protocols written straight into code that execute automatically. They completely strip out the need for middlemen. No more waiting for someone to stamp a paper. This is exactly what allows the projected $300 billion in tokenized real-world assets. We're talking things like bonds and real estate to function seamlessly on the blockchain. Remember those AI agents we talked about earlier? Well, they use these smart contracts to execute their trades instantly. It's the whole shebang working in perfect harmony. Finally, let's look at Section 5, Regulation, Risks, and You, Protecting Your Wallet. Let's be real for a second. Giving algorithms the keys to the financial kingdom isn't without peril. The regulatory frontier is fraught with some serious vulnerabilities that we have to mitigate. First off, algorithmic bias. We absolutely have to ensure that automated lending models don't unfairly penalize safe borrowers. Second, there's the whole issue of DAOs, or decentralized autonomous organizations. If a DAO breaks a law, legal accountability is still pretty murky. Third, as banking gets unbundled into middleware, often called banking as a service, we start seeing systemic fragility. For example, when middleware firms like Synapse collapse, thousands of users can literally lose access to their funds overnight. And finally, there's the critical need to maintain data privacy and geopolitical autonomy, so regions don't become overly dependent on foreign tech monopolies for their core payments infrastructure. It's a lot to untangle. But, regulators are already drawing a hard line in the sand. I want to highlight this quote directly from the payment strategy of the Dutch Central Bank. They state, "Payment service providers will remain responsible for any decisions AI makes and will be liable for damage or loss caused by these systems." The message here is crystal clear, and central banks are definitely not treating this lightly. You can automate the process, sure, but you absolutely cannot outsource the liability. Transparent algorithms and ironclad legal frameworks are an absolute necessity if we're going to protect consumers in this new world.
Which brings us to one final, really provocative thought to take away from today's explainer. As we shift toward agentic commerce, where AI is acting on your behalf and programmable value is moving at the speed of code, if your money thinks for itself, who is ultimately responsible when it makes a mistake? Is it the AI developer? Is it the bank? The merchant? Or is it you? The technology is already here, folks, but society is just beginning to figure out the rules. Thank you so much for joining me today. Keep an eye on your wallet because it might just be getting smarter than you.